Good morning. I'm Amy Nitschke with the Wisconsin Restaurant Association, and I want to welcome you to our session on setting and resetting goals for sales and profitability, led by EWH University. This session is the second of a three-part series. EWH Small Business Accounting is a strong partner of WRAs who offer bookkeeping, payroll, business consulting, and tax planning services. These webinars are hosted by the Wisconsin Restaurant Association, dedicated to the success of the food service and hospitality industry. WRA serves as your primary resource for regulatory guidance, training opportunities, and solutions to relevant challenges. Just a couple of housekeeping items before I turn things over to our presenter. Feel free to submit questions using the chat box or the Q&A feature found at the bottom of your screen. The webinar is being recorded and it will be sent to you in the next day or two. If you would please answer the quick feedback questions at the end of the session, it would be greatly appreciated. And lastly, for those that were registered by 8:15 this morning, you got your handouts sent to you. So make sure you pull those. Those came directly from my email if you want to do a quick search. I will now introduce our presenter. We are very fortunate to have with us today Joseph Hastreiter, partner at EWH Small Business Accounting. As the son of a small business owner, Joseph would sit around the dinner table as a child and hear about how his father, Ed, helped organizations grow their businesses. Fast forward to today, as partner of the family business, Joseph has led the marketing and sales departments while helping over 1,000 business owners achieve the knowledge and tools to run their small business through the EWH University. With certifications in coaching and 5 different talent assessments, Joseph does whatever it takes to find new ways to help small businesses reach their best potential and get results. Joseph's passion and experience is what has helped him build EWH University, a single source for critical information, tools, skills, and support that business owners need to achieve success. Joseph, I will now turn the session over to you.
All right, thank you, Amy. It's such a pleasure to be with you again in the Wisconsin Restaurant Association and to have this second of our 3-part session. And for all of you that are joining us today, we are super excited to have you again today. And actually, just to kind of give us a feel for it out of curiosity, and it's not necessary either way, could maybe some of you just put in the chat if some of you were with us on the last session. Again, that won't impact things here today, but it is just kind of nice to know who's joining us again and who's joining us for the first time. Also, hopefully you did get those handouts as well. Ideally, you had an opportunity to print them. If not, that's totally okay too. You'll be in a great place just to take notes and kind of enjoy the process as we go through today and talk about this idea of setting and resetting sales goals. And we also want to encourage you as we go through today. This is very much a conversation. So if you do have questions, make sure to put them in the chat. Also, so please, for one, put in the chat if you were here last time. Awesome. Thank you, David, for letting us know it's the first time. And the other thing, which just out of curiosity, do any of you have a profit and loss statement handy that you could pull out during this session? Again, it's okay either way. It's just going to help me know how to navigate about the back half of this session, because if some of you have it, we might actually give you some time to work through some of what we're talking about in these numbers today. That'll make more sense when we get into it. And if a lot of people don't have it, then we'll probably just spend a little bit more time covering the information more thoroughly. So that way, when you, go home with it and start working with it, you can easily be able to apply it to your numbers. Or if you have questions, you can follow up with us. So please put those 2 things in the chat if it's your first time with us, or if you were with us last time, and if you're going to be able to have any of your financial information like your profit and loss statement handy for this session. So I'll look for those to roll in here as we go through, and to kind of help keep an eye on that. I will keep an eye on the chat again for your questions as well. Amy, if for some reason something pops up and I don't see it, please let me know that as well. So again, we want to welcome you to this session on setting and resetting goals for sales and profitability. And normally, actually, when we've done this session in the past, we've just called it setting goals for sales and profitability. Obviously, during the last almost 2 years now in the COVID-19 pandemic, we really felt it was important to talk about this resetting part though too, because obviously, people dramatically impacted sales the next day were all of a sudden gone. And hold on one moment. And Amy, can you just take care of that? That'd be great.
You bet.
And it was obviously called, my apologies there. So obviously things overnight were impacted, and really this process of kind of resetting sales goals was a very easy way to figure out how to recalculate what your target needs to be for sales in order to break even, or also to achieve some desired level of profitability. With such changes in variables from food and labor cost, and then being able to monitor other things, it was a very quick way to allow people to kind of reestablish a benchmark to know what needed to happen in order for their numbers to still kind of come out the way they were looking for them, or the way that they needed them, or just to break even or to cover their cost. So what you're going to learn today is a very quick formula. Like literally, once you're familiar with it, in 5 minutes, you can look at your financial statement, set or reset your sales goals based on where your cost and your price structures were, and we'll talk about that today. And it kind of allows you to reset where you're at and what you need to do in order to make things happen. So we talked, let me actually also go into this mode here. And this is called implementing a numbers-based strategy. And what you're going to see on the top there is your desired financial destination. And then obviously we have to go out and navigate the territory. Our accounting then produces a series of transactions. The sound reporting system is all about the accounting, right? The sound, gathering all your bank statements, your credit card statements, be able to put a financial statement together, your POS reports. Again, then turning that into an accurate and timely scorecard, a financial statement. And then also then being able to read your financial statement to understand what's the financial story your numbers are telling you about your business. And then comparing that to what is your desired financial destination. And today, what we're really going to be looking at is what is your desired financial destination. So for any of you that were with us last time, we really spent time on understanding the accurate and timely scorecards in the financial story, right? We reviewed the profit and loss statement, the balance sheet. We talked about this implementing numbers-based strategy. We planted the seeds for key performance indicators where we're picking up our conversation today. So I really want to encourage you, if any of you haven't seen that first session, go back and watch that on the WRA's website with that link, and you'll be able to get a good foundation for that as well. But today's session is all about this desired financial destination in terms of sales and profitability, and how do we figure out what our desired financial destination is based off a couple key numbers, because there's a lot of different numbers or key performance indicators on our financial statement. But the truth is there's only about 5 key ones that are the ingredients for restaurant profitability. Some of you may remember that we talked about these 5 at the end of the last session. Because if you can control your food cost, your labor cost, your operating expenses, your average transaction size, and your number of transactions, those 5 key performance indicators are really what are called critical drivers. Meaning these 5 numbers are pretty much going to be responsible for driving sales and profitability. And if any one of these numbers is off, it will impact things. And as we go through today, you're going to learn how these come into play with the break-even formula we're going to talk about, and then hitting your sales target. So to kind of warm up today for a little bit is let's take a closer look at the profit and loss statement. And some of you that were with us last time may remember this, and this will be a good repetition. So if we look at this screen here on the left, we have sales.
Joseph, let me interrupt you for a moment. We don't see your screen yet.
Oh, I'm sorry. Thank you, Amy. Thank you, Amy.
You bet. We're good to go.
All right, awesome. Thank you all. Apologize for that little malfunction there. So again, this was just the visual I was talking about with implementing a numbers-based strategy, the desired financial destination, navigating the territory, the transactions, right, on our bank statements, credit card statements. Accounting is the sound reporting system of putting all that into place, gathering the information at the end of the month to be able to produce an accurate and timely scorecard like your financial statements. And then understanding the story your numbers are telling you and comparing to that to what your desired financial destination is. Because we also know that just having our destination or goals, just because we have those numbers and have a business plan doesn't mean it's easy, right? We have to navigate the territory, deal with customers, vendors, price increases, and everything that comes with running a business. So today is really, again, about the desired financial destination to give you the key benchmarks for your food costs, labor costs, operating expenses, average transaction size, number of transactions, or get you starting to think about what yours need to be, and then being able to play with these numbers either here during the session today or afterwards, be able to really help calculate what your sales and profitability targets will be based on these 5 numbers. Because these 5 numbers will determine what your sales need to be and what your cost structures essentially need to be for your profitability to come out the other side. And it'll allow you to kind of play with those variables to play what if, to turn what if into what is. And again, that doesn't mean that it's easy. It's just designed to make it simpler, because complexity is the enemy of execution. So to kind of just warm up a little bit with this concept of what we're focused on today, because we're just focused on the profit and loss statement today. We're not focused on the balance sheet. We talked about that a little bit more last time. And again, I want to encourage you to go rewatch that session, because again, back to this slide, we were focused on the financial story and an accurate and timely scorecard. That was where our focus was last time in that hour. And today's really on this desired financial destination. So as a couple examples that we talked about last time, just to understand the power of how these numbers work, because this is going to be kind of the base and foundation of our conversation today, is if you have sales, right? Let's say on the left to kind of give some context here. You have sales, and then you have this thing called COGS. That's a fancy acronym that accountants use for cost of goods sold. So for today's purposes, we're going to be talking about food cost and labor cost, all as part of our cost of goods sold. That'll be coming up a little bit later. So again, you can see sales, cost of goods sold. And again, those are things that go directly into producing our product or service. So without these direct costs, we don't have sales. Because cost of goods sold increase or decrease proportionally with sales. We'll come back to that more in a little moment. But your sales minus your cost of goods sold, or these direct costs, equal your gross profit. So later today, it'll be our sales minus your food cost and labor cost will be our gross profit. Next, then what we have is operating expenses and then profitability. So if you have, for instance, sales of 10, cost of goods sold are 6, gross profits 4, operating expenses are 4, you can see we're breaking even. Now, if they go to sell a second unit, and let's say though, for some reason, and obviously they still sell it for $10, so sales are now 20. And let's say their cost of goods sold rises to $8 a unit instead of 6. So their cost of goods sold was 60%. 6 divided by 10, now it went to 80. 16 divided by 20 is 80%, so 60 to 80%. There was a $2 increase in each unit that they produce. So their cost of goods sold was $16, not 12. Now you can see in this case, when the cost of goods sold went up from 60 to 20, so there was a 33% increase in their cost of goods sold in double the sales. Double the sales, a 33% increase in their cost of goods sold, and notice it wiped out their entire bottom line. This slide is just to emphasize how important it is to control these cost of goods sold, or food cost and labor cost, to ensure profitability flows to the bottom line, because you can see even with double the sales what happens here. It wipes it out. Now, the other thing that's important to remember, now what this would have looked like is it should have been $20, cost of goods sold of 12, gross profit of 8, operating of 4, and profit of 4. So that's what it should have looked like. Now, the other thing to keep in mind though, this isn't just always about controlling your cost of goods, your food cost and labor cost. Those are always key elements. But the other item that impacts this is pricing. Because for instance, instead of, let's say, selling it for $10, let's say you sell it for $8. Well, now even with cost of goods sold still at $6 a unit in terms of the number, now based on just the pricing alone, cost of goods sold, we're 60. Well, now it's 75 because it's priced too low. So in this case, right, gross profits 2, operating expenses are still 4, and now you're losing $2. So these two slides are really just to emphasize the importance of controlling cost of goods sold, food cost, labor cost, because even with double the sales, it can quickly wipe out our bottom lines. And this next slide is really to demonstrate the power of pricing. Things have to be priced right still for the food costs and the labor costs to come out correctly. So with that said, let's spend a little bit time focusing a little bit more specifically on the profit and loss statement, and also to help you bring this into focus here. We are, if you have your materials, we are going to be on page, just so you can see it, and you will see this visual in your book, but if you have the PDF with setting and resetting sales goals, you will see this is marked page 67. It's marked page 67 because this is part of our cash flow fundamentals full day course. It's page 67 here you can look at. And by the way, these are just some of the PDFs that you got along with it, and we'll be referring to these throughout the program today. But if you want to follow along in the book right now, we are on page 67, which is also why you can see that on the PowerPoint slides here as well. So to come back to our presentation view. So let's talk a little bit about, first off, just the structure of the profit and loss statement to give us some more context in just terms of how to read it. Obviously, obviously we start with our sales buckets, right? That's everything that sales gets put into. Obviously, sometimes as a restaurant, you track sales in different categories with food or liquor as just an example. Sometimes those are broken out a lot more specifically. Also, you can see here then we have cost of goods sold, and you may recognize the term that I had used on just a slide ago. Cost of goods sold are direct costs. They only occur when we produce our product or service. It's our cost directly related to producing our product or service, and again, they increase or decrease proportionally with sales, because without sales, we don't have cost of goods sold. Now, the next thing then is operating expenses. Meaning with operating expenses, and this kind of puts direct cost into better contrast. If you made the ridiculous assumption that you were going to stay in business but stop doing business, what expenses would you still have? Meaning you're not going to have sales that are coming in. So these are the costs that are not directly related with producing your product or service. They're everything else. And they are fixed, meaning they do not increase or decrease in relationship to sales. They do not increase or decrease in relationship to sales. So for instance, the most common example is like if you're a golf course in the middle of winter, right, you're still going to have some overhead. You might even still have a maintenance person, right? Even if you don't have sales or revenue coming in, you're still going to have some expenses to support some of the baseline things that are going to happen, right? If your restaurant's closed on a Sunday, right, the landlord doesn't cut you a break for rent just because you're not open on a Sunday, right? You still have that overhead regardless whether sales are coming in that day or not, just as like an example. So again, we can see sales, cost of goods sold, and operating expenses. Now, the other thing to keep in mind is that this is a very simplified chart of accounts of how a profit and loss statement can look. Some of you may remember on the last session that we had, right? We talked about food costs, we talked about labor costs, we talked about controllable expenses and non-controllable expenses. Those are all just different ways of breaking down these expenses on your profit and loss statement based on how you want to look at your business. There's a different franchise that we worked with. They break out food, labor cost, and then they just have something called other store expenses. So, right, they put all their operating expenses under that term, other store expenses. So this is just a simplified way that we're looking at it right now with cost of goods sold and operating expenses to help really bring these terms home and to help help you, empower you to really be familiar with looking at your financial statements and where the numbers are and what the terms mean. So we can easily translate the language of business for you, which is our numbers. The other thing real quickly is, why do we look at months? Because we talked about in the last session, one of the #1 challenges that most business owners are making, the first critical accounting mistake. And if any of you haven't seen that article, highly encourage you to go check that out online. But is they manage the company through their checkbook. And if you're with us last time, as we went through the balance sheet and the profit and loss statement, there are so many things that impact our checkbook outside of sales and expenses. We buy equipment, we pay down notes, we distribute money to us as the shareholders. Our financial statements allow us to really understand how we arrived at our cash position, our sales position, or profitability position. And that's one of the reasons we look at months. So we're not just running our business by the checkbook. And the fact of the matter is, we as a society have decided to pay all of our bills monthly. Our rent, our utilities, a lot of our vendors, sometimes that obviously happens more than once a month. But we look at months because if we're going to get all those individual statements that kind of tell us how we did there or what we spent, we want to have a financial statement that takes all of that information and summarizes it, like on the profit and loss statement, sales minus expenses equal profit. And you may remember, if you were with us last time, and if you're not, I'm just encouraging you to go check it out again. There's 3 scorecards: the profit and loss statement, the balance sheet, and the cash flow statement. And each one is designed to tell us one very particular part of our financial story. All 3 of them make up the whole story. That's why we want financial statements every month, to give us the key aspects of the story of what our numbers are telling us. Because all numbers tell a story. And once we understand the story, we can understand how to quickly recalculate our numbers to figure out what decisions we need to make, activities we need to engage in, and what we need to execute next month to be able to improve the numbers and shift our results. So that's why we look at months. And just to kind of re-emphasize this a little bit more, again, direct costs only occur when you produce your product or service. They're directly related to producing it, and they increase, decrease proportionally with sales. And the next thing is the gross profit and gross profit margin percentage. Now, again, if you remember from going back to this slide real briefly, is this gross profit is after our cost of goods sold, like after our food and labor cost, for example. So to come back here, is the gross profit is how much you have left after the direct cost to produce your product or service. So for instance, after you cover your food and labor cost, it's how much you have left to cover all those other operating expenses. The gross profit margin percentage is for every dollar you sell, you make X dollar or X percentage, meaning it's what you have left over. Also, it means for every dollar you sell above your break even, you get to keep X dollars or X percentage. That's a really important point. For every dollar you sell above your break even, then you get to keep that X dollar or X percentage. That's one reason your gross profit margin is so important, because once you establish your break even, your gross profit margin is what flows to your bottom line on every transaction. Okay. Also, again, also just to kind of reemphasize this, is we talked about our operating expenses as indirect costs. Again, if you made the ridiculous assumption you were going to stay in business but stop doing business, what expenses would you still have? Because they are not directly associated with producing your product or service. They're everything else. And they do not increase or decrease proportionally with sales. The other thing is, and if some of you want, you can put this in chat real quick, is how many of you have heard the terms about fixed and variable costs before? If you've heard about it before, just put it in chat. If you've heard about that terminology before, our indirect cost are our fixed cost. The reason we don't use that terminology here is because a lot of times, if people think that their phone bill goes from $100 to $150, they'll think that's variable. Now you have your phone bill, regardless of whether you have sales coming in the door or not. Just because the amount might slightly vary from month to month doesn't mean it's a variable cost. So these are our indirect or our fixed cost for any of you that are just somewhat familiar with that terminology and language. Okay. Also, just to check back in, if any of you do have some of your financial information handy while we're going through this, just put this in chat. It doesn't look like anybody does currently, but just we're about halfway through. I just want to give everybody an opportunity to check in on that again. So also, if you have your handout handy, and if you either printed it or you can also do this on a separate piece of paper and you can kind of follow along with us. This also, by the way, is now going to be on page 72, which looks like this in your book. Be page 72 in the book. And as you can see here, we're going to sell cheese heads. We're celebrating the great year the Green Bay Packers are having and the good victory they had again yesterday. And this is just briefly to help us get us warmed up on a few of the numbers. So either just take some notes on a separate piece of paper. You can kind of start just by writing, sell 1 unit, 5 unit, 10 units like this here. And you can kind of just jot these categories down here as well. And then we're going to kind of just go through understanding how our direct cost, indirect cost, gross profit, and these key numbers drive our break-even point in profitability with this simple example. So if we sell a cheese head for $10 and the direct costs are $6 to produce each cheese head, and let's say we got $20 of overhead to produce these cheese heads, right? So if we sell 1 unit, it's going to be $10. And our direct costs are going to be $6, which means our gross profit left over is $4. Now, if we're indirect, now also keep in mind, we want to look at our gross profit in terms of a percentage. So 4 divided by 10 is 40%. Now, what this also means, by the way, to help emphasize some of these definitions we talked about, is $10 times 40% means we'll have $4 left over. Or if we know that we make $4 on each unit and we sell 1 unit, we'll have $4 left over. So just notice the math works both ways. The other thing is keep in mind, sales are always 100% of sales. Cost of goods sold, 6 divided by 10, right, is 60%. So our cost of goods sold are 60% of our sales. Our gross profit then is 40% of our sales. So if our sales were $10, 40% is the $4 left over. Now, the next thing is our indirect cost, or $20, our overhead for what we're doing, which means our profit or loss is a -16. So we're losing $16 at 1 unit. Now, if we sell 5 units, that means $10 times 5 is 50. Our direct cost, 6 times 5 is 30. Thank you, David, for your feedback. That's wonderful to know. And the gross profit is 20. And please, if you don't have that, put that in there too. That would be good to know too. But if anybody else does have their financial information handy, please put that in there too. Thank you. And so if our gross profit is 20, if we take 20 divided by 50 again, you'll see that's 40%. And then if we also again look at, we sell $50 times the 40%, we're going to have $20 left over. Or again, if we know that we make $4 in each unit, we sell 5 units, we're going to have $20 left over. So notice the math works both ways in terms of how much profitability we'll have left. Everything's 100% of sales. Our cost of goods sold, then 30 divided by 50 is 60%. Now, with a gross profit of 20 selling 5 units, our indirect cost is again still $20. Our overhead hasn't changed. Still $20, but now we're breaking even. So at $50 and a 40% gross profit margin, our gross profit is finally going to be $20, which will cover all of our indirect operating expenses, which means we'll finally break even. At 1 unit, we were not breaking even. At 5, we were. Now, To go to 10 units, if we sell 10 units at $10, we have 100 in sales. We got $60 in direct cost of goods sold, and $40 for gross profit, right? Because direct costs were 6 times 10, which is 60. Now our gross profit of 40, right? Again, 40 divided by 100 is 40%. Now also, again, notice if we sell $100 times 40%, then if we then we have $40 left over. Or if we sell $4, sorry, if we make $4 in every unit and we sell 10 units, we're going to make $40 as a whole. So again, you can see the math working both ways on all three of these examples, whether we sell 1 unit, 5 units, or 10 units. And it's just to help you kind of determine how you like to look at the math. Some people like to look at how much they're making per unit. Some people like to look at the percentage that they're making, off every dollar that they sell. It's really up to you and how you want to look at it. It's really just to help reinforce that here. And then, so hold on one second. Ray, if you're out there, can you mute yourself, please? Thank you. Then what we can see is, so now that we have a gross profit of $40 because we've sold 10 units and we've maintained a cost of goods sold of 60, we've maintained a gross profit of 40% because sometimes when we scale our business, we don't, our cost structures don't maintain themselves. There's more to manage. There's more to make sure lines up and to control with, scheduling and inventory and things like that. But you can see now our indirect operating costs are still 20. They haven't changed. And now they're profitable at $20. Now, also notice here, let's look at these two ways. Is we made $20. And the first thing we noticed is we were breaking even at 5 units. So in this example, we sold 100. $100, we were breaking even at 5 units, which is $50 in sales. On this particular one, we sold 10 units at $100. So we sold $50 above our break-even point, right? Because at 5 units, we were breaking even, and we sold $50 above our break-even. So $50 times the 40%, notice, is the $20 that went to the bottom line. Because once they broke even, all $50 above this break-even that got us to the 100, that in 40%, the gross profit on that entire amount, the 50 times 40% is the 20 that floated to the bottom line. Or what you also know is you sold 5 units above your break even, and you made a gross profit of 4 on each one. So the 5 units times the 4 is the $20 left on the bottom line. So that's to help understand how the direct cost, gross profit, and indirect cost all shape our break-even point and how many units we have to sell. Now, again, to emphasize, excuse me, again, to emphasize it, they were able to maintain the same gross profit margin percentage through all these examples. That is a key variable to make sure that that works out. Excuse me, one moment, thank you. So again, it's important because the minute that gross profit would change, it would change the dynamic behind how these numbers would work out. Okay, so now with that said, now that we've warmed up our muscles a little bit here, is you may also have this handout, and if you have it handy, pull it out. And that, or also if you just have some note paper, or you can just follow along on the screen here too as well. Also, just so you know, on this handout, page 1 is to kind of just fill in the blanks as we go through this brief little exercise again. And then the second page is actually for you and your company, so that you can look at your financial figures and put them in, and then understand your break even and what else we're going to talk about today with that. Okay, so let's briefly go through this slide. And this is because what we're going to talk about here is the break-even formula. And that's like the recipe. That is like the recipe for understanding your break-even point. And what you're going to see in front of you here are the key ingredients that go into understanding that break-even point, kind of like we just did on the previous slide. So you can see, let's say our revenue is 25,000. And so first off, if we know our gross profit is 15,000, right, that means if we back into what our cost of goods sold in, that's going to be 10. And 10,000 divided by 25,000, again, is 40%. Again, this is just to help reinforce taking our numbers and turning them into a percentage, because you need to, you must be looking at your financial statement with percentages next to it. If you're pulling out your financial statement without the percentages on it, you want to make sure to get the percentages on there, ideally both for the current month and for the year to date. If you have more questions on how to, kind of have your financial statement set up that way, please contact us, let us know, and ask us some questions regarding that. But the key thing is taking the number on there and turning the percentage, because remember, our cost of goods sold increase or decrease proportionally with sales. And unless we have that percentage there, we won't be able to understand the relationship of our food and labor costs, for example, to our sales. We'll have a solid number there, but given right, sales are bouncing up and down every month a little bit. We want to know what percentage, not just the number, that those costs are in relationship to sales, because that's what we need to keep in line, that relationship. So you can see your cost of goods sold here are 40%. Then if we look at the gross profit, right, 15,000 divided by 25,000 is 60%. And then if we have a $2,800 in the bottom line, our operating expenses will be 12,200. And that's 40, and then 12,200 divided by 25,000 is 49%. And our profit and loss is 2,800. If we can turn that into a percentage, it's 11.2%. 2,800 divided by 25,000 is 11.2. Now, just to plant this seed for all of you, those numbers, by the way, we're taking off this page in your book. This is page 73. And you'll notice just by looking at this, right, sales are 25,000, cost of goods sold are 10, total operating expenses are 12,200, and then net income is 2,800. You can see the percentages here. Cost of goods sold is 40%. We got 48.2% here for 12,200 on that, and the net income is the 11.2%. So that's where that came from on that page, and this is also designed very visually friendly, so that if you're looking at your profit and loss statement, you can see where to grab these numbers from. So you don't get lost in all the detail and expense categories. You simply need your sales, your cost of goods sold, your operating expenses, and your net income. And then also this little break-even spreadsheet we gave you is to simplify it, excuse me, for you visually, so then you can plot your numbers over to it and quickly calculate your break-even point. Okay, so with that said, let's jump back to this. Okay, so we're looking at those numbers, and you see them on this page. This is our break-even formula. And our indirect costs, if you remember, are like your operating expenses. So our indirect costs were the 12,200. The gross profit, and actually let me just do one thing while we're doing this here. Just going to pull this up side by side so you can see this a little bit better. I'm sorry, I'm having some monitor challenges here. Be resolved in just a moment. If you have some water next to you, it's always good to stay hydrated. Take a sip of water. Take some of mine as well. Okay. And all right. So what we can see here is the indirect cost. Make this a little bit smaller. Hopefully this is working out okay for you guys. So, right, the indirect cost here, there we go, is 12,200. Notice that is the same number that we have right here on our financial, that 12,200 right there. So this total operating expense number is our indirect cost number. Now the gross profit percentage number, right, is 60%. That number is being pulled right here from your financial. It's the 60% gross profit number there. So as long as we can locate, our indirect costs, which are our operating expenses, and our gross profit margin percent is 60%, and assuming our financials are correct and all the proper procedures are being done at the end of the month to tie out our financials and make sure they're accurate and finalized for the month, we can simply take those two numbers and then we can calculate our break-even point, which is the 12,333. Because you will notice if you take those numbers real quick, is the 12,200, and you may want to just do this with a calculator if you have a chance, divided by the 0.6 equals the 20,333. Now, just to also kind of reemphasize how this works, notice that this company had 25,000 in sales. And notice it had 2,800 on the bottom line. So notice, for instance, it sold 25,000 minus the 2,333. It sold $4,666 over and above its break even. So sometimes the natural question is, well, why wasn't that on the bottom line? Well, because you still had, cost of goods sold, or like food cost and labor cost, on every dollar of those sales that you had to pay for, because they were direct costs that went into producing your product or service. So if you take, again, the 4,666 times the 60%, notice you have some rounding there, but that's your 2,800 number. So that simply then helps you understand then how that gross profit margin percentage falls to the bottom line once you've covered things up and above your break even like they have in this example. Now, the other thing is, though, real quick, is, and let's actually, well, I have these numbers here so we can go through it a little bit more efficiently, is what you're going to see on the right is a little bit more detail here. So first off, if their break even was this 20,333, their break even, if this was a 12 months, so if you took 20,333, it always hurts to run these numbers, just send your calculator home if you want. But if you divide that by 12, you're going to get 1,694, which is how much they'd have to sell a month to break even. Then if they divide that by 4, you'll get 424 roughly with rounding. Now, if you divided that by, let's say, 30 days, you take 424 divided by 7 days, you're going to get about $60 a day in sales. And if you, let's say your average transaction size was $10, meaning, for example, let's say you pulled out your POS system for the day, the month, or the year, you looked at total sales, total transactions, you'd be able to very quickly get to what your average transaction size. So if your average transaction size was $10 a day and you needed $60 a day in sales, you'd need 6 transactions. Now, also to take this a step further is, let's say though you wanted to build profit into this. So what you do is you would add the profit to your indirect cost. Oopsies. So you can remember that our indirect cost or our operating expenses were this 12,200. Let's say though they wanted to build in a profit of $5,000. So they'd add this profit of 5,000 to their indirect cost, right? They don't want their profit to be variable. So if you take the 12,200 plus the 5,000, you're going to get 17,000 divided by 0.6. That's when you come up with your $28,666 in order to break even and have a $5,000 profit built into it. You divide that by 12 months. It means in a 12-month period, each month you need to average $2,388 in sales. Your break even per week is $597 because if you divide 2,388 divided by 4, you'll get 597. And if you get 597 divided by 7, you'll get $85 a day. And if your average transaction size is still $10, then you'll need 9 transactions a day in order to achieve that level of profitability. Now, just as an example to show you real quick, if you take the 28,666, which is right what it would take to have 5,000 of profit to break even, which is what it would take to not only break even, but $5,000 of profit built into it, is if you take that times 0.6, that will tell you how much profit you're going to have left over after you cover your cost of goods sold. So for instance, in that case, you had 28,666. And if you take that times 60%, that means their gross profit will be, my phone's not showing up here. Their gross profit will be about 17,200. 17,200 minus the 12,200 equals, with rounding there, the roughly the $5,000 profit that's flowed to the bottom line. That the extra bit there might have been a little bit too much, but you can see the point that we've been reinforcing all along. This is simply adding in how much profit do we want into to add into our formula here, so it's calculated into our break-even point. That way you have your sales target, your profitability target based on that profitability being in there. And then when you can see this here, you can nail it down by month, week, day, transaction size, and number of transactions to have the level of specificity that you're looking for. Now, why this is all good is it tells you how much activity, productions, and sales you need to in order to achieve a desired level of profitability. Makes you also, how often are you reviewing your pricing? I know with a lot of the restaurateurs we've talked to recently, I know one of them in particular had done 2 price increases just in the last year. Obviously, our cost structures have been dramatically impacted. Finding labor has become exceedingly difficult. So being able to review your pricing to see how things are staying in line is key to making sure that your profitability stays in line. These key numbers can stay within the ranges that they need to. It's also really important to remember more businesses go out of business because they are underpriced, not overpriced. This is a quick example of that. There used to be a restaurant in downtown Milwaukee, and I actually go to visit it frequently. They always had specials or happy hours, and not that that's a problem, but it was always going on for them, like every single day. To compound that, you go in there, you'd sit down and eat, and I just remember looking at those menu prices and thinking that they were way too cheap. I just learned from an early age how numbers work. Math is pretty black and white, and it was just a matter of time until I knew something happened and that equation didn't work anymore. Sure enough, it was about a year later, walked by, they had finally closed, and a new restaurant had opened up in that space. And this was a restaurant that you'd go in on a Friday and Saturday night, and first off, the line going out the door was huge. The cheapest drink you were probably going to buy in that place was $7, $8, $9. And these are all college kids, by the way, kids that are, eating ramen noodles. So it's just an interesting point to reflect on. These people were going there because of the atmosphere, because of the value the place brought. It was the place to be. It was where everyone was, where their friends were, and they had a great atmosphere. They had a great menu. They had great drink selection. And that was the other thing. This new place didn't even have food on the menu. It was just drinks. And that place became one of the most popular happening places on North Avenue while that partnership was still in existence. 2 very different businesses, 2 totally different strategies, totally different outcomes, same location. It's not what you do, it's how you do it. And we could tell you story after story of people that have went out of business because they're underpriced, not overpriced. So it's just a good reflection to think about how often are you reviewing your pricing. And if you also just think about for a moment, like Jimmy John's, Cousins or Subway, right? They all kind of have a unique value proposition. Jimmy John's is sub so fast you'll freak, right? Cousins is better bread, better subs. Subway, right, has now it's the $6 footlongs, right? But they all have a slightly different way in which they're positioned, in which they look at the value that they offer. And just as a very simple example, right, Subway has 6 and 12-inch subs, Cousins has 7.5 and 15. So you can't just go and look at the menu prices and equate apples to apples. It's to help you really look at what's the value, the uniqueness that you bring, in pricing it accordingly, so that you can have the sales and profitability you need to run your operation effectively, and for you to be able to take home what you deserve. There was a shark that said once, entrepreneurs are the only ones working 80 hours a week so they don't have to work 40. This is to help make sure that you can get the return on the thing you put so much of your time into, which is your business. So with that said, I am going to close on this story, and then we're going to open it up for questions. And Amy, will we have a few extra minutes again?
Yes, absolutely.
So I'm just going to put this on the these two examples on the screen here real quick. And to help bring this home for you, a little bit of a sports analogy. In 1983, the LA Lakers played the Boston Celtics in the NBA Finals. And in that 1983 Finals, the LA Lakers lost to the Boston Celtics in Game 7 by 11 points. That year, Pat Riley went to his players and he said, you know what, guys, we're going to work twice as hard next year and we're going to win the NBA Finals. And Pat was a very smart coach because he listened to the feedback his team gave him. And after he shared that with his team said, Pat, we worked as hard as we could last year. We can't work twice as hard this next year. Pat reformulated his approach. He went back to his players and said, you're right, we can't work twice as hard. What I do want you to do is take 5 areas of your game and improve them all by 1%. Like maybe your food cost, labor cost, operating expenses, average transaction size, and number of transactions, just as an example. But he said, I want you to pick 5 areas of your game and improve them all 1 by 1%. We only lost the finals by 11%. If we do that, we'll easily win the finals. Sure enough, the next year, the Boston Celtics played the LA Lakers again in the NBA Finals. And this time, though, the LA Lakers came out on top in 6 games, not 7. So you can see the power of that strategy. And here, let's just look at some numbers. And this is a little bit more detail. We talked about, for instance, your transaction size and your number of transactions. So this is a little bit more detailed where it's looking at your number of leads per day, how many people actually sit down and start eating in the restaurant, average transaction size, and the number of transactions per day. So like, for instance, the number of leads per day, that could be like the number of people that walk past on the street, maybe even some of the people on your social media feed, depending on how you wanted to look at that. I know I was in Santa Barbara once, and there was a number of restaurants on this very busy street, and they had somebody out there that would greet people, right, and ask them if they wanted a menu, right? Those would be kind of like their number of leads in that particular case. And then she obviously had a more, that restaurant had a better rate of converting people to sit down in the restaurant that were walking by because they did something that engaged the people that were walking past the restaurant. So that total will give you your number of customers a day. Another good example of this is I used to live downtown, and there was one restaurant I used to love eating at. And unfortunately, though, on a number of occasions, I would go sit on their patio, which for what had to be 20 and 25 minutes. And on a few occasions, I got up and left. That's an example of not converting, for example. Just to kind of give you some context to the definition. So let's just say you got 100 leads a day. You want to go from 50 to 52%. So you want to have 50 to 52 customers a day. Let's say your average transaction size was $25. We want to get it to $26.75. And let's just say there's 1 transaction per day. Total revenue would go from $12.50 a day to $13.91 per month. It would go from $37,500 to $41,730. In a year, it's $450,000. And then per year, it would go to $500,000. What's important to emphasize here is an extra 2 customers a day, an extra $1.75 each transaction equated to a $50,760 increase in sales. A slightly even more fine-tuned example, the only variable we're changing here, they still have 150 customers a day. Their average transaction size, though, goes from $9.25 to $9.99. Everything else stays the same. So total revenue would be $13.88 a day to $14.99, $41,625 to $44,955, or $499,500 a year to $539,460. You can see that's an increase of $39,960 in sales off a 74-cent average transaction size. Just to help understand the power of bringing that home. Okay, we have been through a lot. I want to open it up for questions for you, any of them that you guys have. And the first thing I want to also recommend to you is taking your numbers and going over to this sheet at some point after the session and plugging them in. Also, if you need our help, please reach out to us, schedule a strategy session. We'll help you figure out your numbers with your financial statements. We also have a lot of our other essentials and mastery courses you can find online. Follow us on Facebook and LinkedIn. And remember, we are only a phone call away. So with that being said, who has questions out there? And I'm also going to put these 5 magic ingredients up here so you can have them right front and center with you as well. What other questions you guys have?
Thank you, Joseph. Yes, feel free to use either the Q&A feature or the chat box to ask your questions. So we have Joseph for live here for a little bit yet. I know we're almost at the top of the hour, but feel free to go ahead and shoot those over. We're happy to assist as there's questions. We'll give everybody a moment here. While we're waiting, Joseph, maybe you want to tell us a little bit more about the last session in this series coming up on December 13th at 2 p.m.
Yes, thank you very much. So we have a great session for you coming up on the next one. These first 2 sessions have been about the numbers. 1, reading and understanding them. 2, being able to design your sales and profitability goals here. And really the next thing then is once we understand our numbers, we have to understand how to be able to lead ourselves to those actual results, because we all know that just having this desired financial destination, it's not as simple as easy as making that happen. And one of the key things to be able to turning our numbers in reality is working with our team, both internal and external, right? Retaining our staff, and then also being able to give people a great experience when they come in. So the next session is called 4 Paths to Superior Service, because it's really designed to help us better understand each other. Some of you may be familiar with the platinum rule, right? The golden rule is treat others as you want to be treated. The challenge is, though, if we're different, how I might want to be treated and how you want to be treated could be different. The golden rule only works if we're the same. So what we're going to talk about is the 4 paths to superior service to understand, why are some customers, for example, as I heard one hotel owner tell me, so demanding while others are so friendly and so accommodating. Understanding these 4 pathways to superior service will allow you to meet your internal team or your external team where you're at and know how to provide them with the exact type of service that they're looking for. Because sometimes, depending on the type of person that we're interacting with, how they'll want to be serviced will be different than somebody else. So you're going to learn in this next session about these 4 different styles and also how to recognize them very quickly. And then also some tips about how you can modify your communication and your expectation to be more successful in each one of those outcomes. Also, I know this might be a little bit of a new area for some of you, especially given that a lot of your exposure to us has been through EWH Small Business Accounting and Understanding the Numbers. As some of you are familiar with us and some of you are newer, our EWH University for Small Business, though, is a comprehensive program to help businesses in all areas. I joined our accounting firm as a partner over 10 years ago now. I've been with the firm for 13 plus years. And over that time, we started with our numbers workshop, but my love has always been for people and for business as a whole. And how do we actually make all of that happen? And over time, people would ask for one workshop or another, and we kept adding tools along the way so that our university was a full service business training and coaching solution to be able to meet business owners where they're at. And the next most logical thing is after we understand our numbers, we have to understand how to take that information and actually turn it into reality. And that's where the people skills come in, and understanding our team, people, communication, but primarily leadership. What our university is really about is helping people be able to lead in 3 key ways: their numbers, their people, and themselves. And that's why our next session is called the 4 Paths to Superior Service, to pick up on that next step in the process, which is better understanding our people internally and externally, so we can make it a little bit simpler to figure out how to influence ourselves and others to be able to hit these numbers. Does that help explain it, Amy?
Yes, thank you. And just a reminder, everybody, that is December 13th at 2 p.m.
Awesome.
So before we conclude, I just want to make sure if there are any other questions. Otherwise, we will send you this recording as well as Joseph's contact information so you can follow up with him.
And I do have one more quick thing, Amy, just to
go for it.
So also, just so you guys know, and I know, because I know somebody had asked about this on the last session, you also did receive a handout here. And what this has is different types of restaurants will have different food cost and labor cost, and sometimes these bottom line percentages. So what this summary sheet is for you is, these were just some different restaurants that we had worked with. We've kind of put the numbers in as an example: full service, limited service, quick service, quick service. And then you can see some other specific examples with some restaurants in there. So that's one reason why you're going to want to look at your numbers, see where your food cost, labor cost percentages are currently, where they should be, and what you can do to improve them. Also, for any of you, if you're not getting a financial statement, that is definitely going to be a place you're going to want to start. So I also just want to emphasize, we are a phone call away. If you want help running through your numbers, contact us with my contact information. We'll set up a strategy session, and in 20-30 minutes, we can easily run through your numbers and calculate what your break even is, or whether your profit built into it, and what your average transaction size and transactions need to be in order to hit it. So these 5 things that we got on the screen here, in 20-30 minutes with your information, we can bring it home. If you're looking for help, I'm just re-emphasizing that we are here to have your back. Thank you.
Well, thank you so much, Joseph. Again, yep. Thank you, EWH Small Business Accounting and EWH University. I think that's it today. As far as questions, it doesn't look like we have any at the moment, but I'm sure it's a lot of information to digest. And in this particular case, a lot to compare with what they have and get going before there's questions, I'm willing to bet. So. Yep.
And follow us on Facebook, and again, reach out with questions. I know today was much more data driven. I do hope you're able to follow it. It may also help to go back and rewatch it once. And again, if you have questions, please reach out to us. We're here for you.
Sounds good. Well, thank you so much, Joseph. Thank you, everybody, for attending today, and you all have a great week.